Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So if we're looking at, let me click Windows for just a second. If we're looking at this area and we're concerned about this, the exposure we have to a dollar rally, we may be interested in the call, and maybe we look at the 96.5 call. That's where my pointer is. So I'm looking at the July's, the 96.5 calls. That Friday is July 17th. That I did check, but obviously be certain, check the expiration calendars in the ISE site. And I plugged in a position being long one of those options. And I did that just to mock up some of the values. Obviously, it could be one contract, could be 100 contracts, but one contract gives us a chance to mock up some of the values. And what I thought we would take a look at is a display of, for instance, what might happen to the delta over the period between now towards that expiration. Now remember, in our little story, we're talking about putting on a hedge. We're talking about perhaps I'm long yen, perhaps I'm long Japanese stocks or other instruments that are denominated in yen. So whether it's a speculative position that I'm trying to hedge or a real investment position and a portfolio, our story, our scenario is that I'm concerned about that dollar rally versus the yen. So I created a chart in which the left side is delta, and it's scaled 0 to 100 in this case because it's on a dollar basis, but it's the same concept. And each of these lines represents a different time period between now and the expiration. And if you bear with me a second, I'll show you what they are. It's really not a big mystery. I left volatilities unchanged, and of course volatilities will change, but for the purpose of having some benchmark, I left volatilities unchanged. You'll see it's all set to current. And the blue line is today, is the delta today over asset price. So here's the delta over asset price, the blue line being today. And the green line is the delta over asset price on June 10th. I kicked out 2 weeks. Then I kicked out another 2 weeks, the magenta line, June 24th. And I kicked out another 2 weeks to July 8th, which is nearing that expiration. And that's the yellow line. So if you take a look here, the time is decaying from blue to green to magenta to yellow. Now, what are the prices that we're dealing with? Well, right now, or right at the moment, we see that the index is 95.34. I'm pointing out it in my option station analysis. So the index right now, we're sitting right about that spot. If you can see the little tip that comes up with my crosshair, I'm at 95.30. Oh, I got it on the nose. 95.34 asset price. That delta number is just my horizontal line. It doesn't mean anything. It's not where the plots are. But that's where I am today in terms of price. So what I can consider is that the delta, which you can see is roughly 45 or so. That's the blue line is today. If the market stays pretty quiet, I'm going to see some serious erosion in that delta. And if the time goes and I see some decay, that delta is going to erode even further. The point of my story is being aware of this is saying that my hedge may become less valuable, less correlated.
Effective.
Yep, less effective, thanks, than as that time decays. So I want to be aware of the fact there may be a sweet spot in there. Most of you probably, if you're familiar with options, you know that. There may be a sweet spot in there where I have to say, if I still need that protection, if I still want that call or similar protection, where I need to kick it forward before it works too far against me. At some point, I know we'll see, as time changes, we'll see gamma change and other factors will be happening as well. But I'm just trying to point out this idea of being aware of the change in the effectiveness of a hedge, and also that time factor is going to work. This is a European style option, so there's no, and it's cash settled. There's no early exercise or early assignment. That can be, let's not call it a blessing or a curse. It just is, and be aware of that in the pricing as well. Again, since we titled this hedging and combining it with other instruments, I wanted to point that out, since you have no time dating issue if you own the spot pair, or if you own a portfolio of Japanese stocks and you're not time dating it, and you may find that your hedge may be better off moved or replaced or lifted, because at some point it's not going to help. And my point was that, remember, those different colored lines are different dates in the future. So if the price stays exactly the same, time is going to work against that delta.
That's really great, Stan. That's really cool how that works. I like that.
Yeah, take a look. If you have TradeStation, I just opened up this little drop down. If you can see it, the y-axis can be any one of the Greeks in dollars or in point or percent terms. I set this to delta dollars and made kind of a cleaner picture. And it could also be P&L. And then the x-axis can be price, time, or volatility, one of the three risk inputs. So as you get into modeling, and by the way, I'll since you mentioned it, Steve, let me say one other thing for TradeStation users or those interested. You may know that you can plug positions into the analysis window. That's what I did. I just plugged in one long call. And of course, you're going to plug in positions you're actually considering or positions you actually put on. But sometimes you can just plug in a single long at the money or just out, or a single short at the money or just in or just out. And you can do this in a very academic way that I did here, of creating a picture of, well, what might happen to the delta over time and how is that going to affect me, and easily change the chart around. The y-axis could be any of the Greeks. The x-axis could be any of the three risk factors. Let's take a look at one more example. I walked through a similar example, but as I said when we first began, I wanted to look at yen and then I wanted to look at euro, and I wanted to look at those in part because yen, the price expression, is what we're used to in the ISE. Euro is different. That's the reverse. Here it's euro versus dollar. This is the spot pair, euro USD. And the prices are expressed in the reciprocal in the ISE index. I did the same intervals in the chart, so we're looking at an analogous layout: 111 minutes for the index, 288 minutes for the spot pair, and I put in the 20-bar arithmetic average for both of them. Again, I was quite astounded to see how closely the charts reflect each other, and how closely the trends reflect each other. Remember, we're covering many more minutes in this chart, not minutes. We're covering more minutes per bar, but more total minutes. And here we're looking at just that slice of the day. Yet the trends hold up, the pictures hold up, even the moving averages are remarkably close. And by the way, if you're not familiar with how we plot it, if you're used to a web-based service, which usually doesn't do moving averages the way a technician would really want, the moving average is a 20-bar. I see that question came in from someone in the chat. It's a 20-bar simple arithmetic. And in TradeStation, it is 20 bars. It's not 20 days. So in the case of the index, it's 20 111-minute bars. In the case of the spot pair, it's 20 288-minute bars. In TradeStation, we like to say TradeStation thinks in bars, which is also good advice my father once gave me.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.